Hello, everybody. So, what a day it's been already. Stocks keep going up. The market is excited about the Fed this afternoon. MicroStrategy and Tesla are my two biggest positions. It's getting uncomfortably large, more than 60% of my portfolio in these two. MicroStrategy, what am I doing with that? Well, I'm holding it for the long run, and I'll see you in 2045, and maybe I'll borrow against it in 2045. That's the plan. This asset to me is, entirely unleveraged. I don't own options. I just own outright common stock, and all I can say is I'm happy. It looks like they're going to be added to the Nasdaq, and they are the Trojan horse. They are the Trojan horse which turns the funds of the traditional financial system either via bonds or either via perpetual bid of stock by ETF. It takes the funds from the bond market, takes the funds from the common stock issuance, puts it into Bitcoin, buys Bitcoin, Bitcoin goes up. When Bitcoin's up, MicroStrategy gets excited, the market gets excited, MicroStrategy goes up more. When it goes up more, it can issue more bonds, it can issue more stock, etc., etc., creating a virtuous loop. It is akin to a big short, quote unquote, the big short or a big short on the US dollar. This is how I see MicroStrategy, and I think this is a story that's going to be staying with us for longer than a decade, perhaps decades to come. Most people still don't get this company, and that's because it's too much work. Because to get this company, you have to get Bitcoin. And to get Bitcoin, well, you could start with a Bitcoin standard, but that's already a 12-hour book. And then how much more education do you need? The market is slowly going to catch on, but I think this stock is a blessing. It's an absolute blessing. I can't even describe how I feel about that. So excited to see that. I am working on more videos on MicroStrategy. Stay tuned. I know a lot of my most viewed videos on this channel are on MicroStrategy, so I'm working on a few more videos. Anyways, moving on. Tesla's up. It looks like it's up a lot. It's up more than 20% in 2 days. But actually, if you look since the beginning of the year, it's only up 33%, right? So look at the delta in performance. MicroStrategy is up for 60%. Tesla is up 33%. My view is that even though it feels expensive to see 297, because we've seen it cheaper for 2 years? We've seen it cheaper than that for 2 years. My view is that the stock is still relatively cheap compared to the potential, but that's a view that I base mostly on my qualitative analysis of Tesla within its marketplace. Tesla, when you look at the numbers, when you look at the metrics, it looks insanely expensive. And MicroStrategy, when you look at the number and the metrics, and if you were to use the same lens at Tesla, it looks nonsensical. It looks like it makes absolutely no sense. That is because both of these companies cannot be analyzed through the traditional linear long-term view of a business where all the growth is going to be 50% a year, and they're going to make so much money, and they're going to achieve operating leverage. This doesn't work for MicroStrategy because MicroStrategy makes a lot of its money via the balance sheet, via the cash flow statement, via cash flow coming in through the back door. Cash flows do not come through the front door of revenue, so MicroStrategy makes no sense when you analyze it through the lens of a traditional business. It should be analyzed through the lens of a bank. Tesla makes no sense if you analyze it without taking into account exponential growth for its future divisions and, of course, the Elon Musk premium. But both of these stocks, I am so happy about the performance. Moving on to MercadoLibre. MercadoLibre is down 15%. Again, one of these. This is one of these opportunities. In this time, the market is just too short term, and the market doesn't look long term. And everything's doing outstanding. They grew 35% year over year. This is a business that's still growing at 30%, even though it is quite large. And as you can see, everything's doing well. The strong GMV, operational KPIs are outstanding. They're growing credit Perhaps a little bit of a drop is due to the fact that they're drawing credit because, people get scared whenever these companies land more money. This is the same story as StoneCo, but credit is still a small story of MercadoLibre. Obviously, to me, the big reason why the stock is down is because they are highlighting short-term margin pressure. And of course, the market only cares about the short term. And the market only cares about the short term, and that's why the stock is down. I view this as an opportunity. This is an opportunity for me. I may be adding to this one. If I do, you'll know. In my Patreon, I put my buys there. Moving on to MercadoLibre still. Comparing MercadoLibre's valuation compared to the other e-commerce stocks, the other stocks in the megatrend. Right, the megatrend is e-commerce. Nations are moving to online shopping. Online shopping makes the most sense. And so when you compare the valuation to all of them, really, which is all of the high growth companies in that e-commerce sector. Not only is it the company that's growing the fastest at 34%, it's also the most profitable company. It's also the highest Rule of 40 company, and it is also the cheapest company, believe it or not, at a 0.26. I suppose this is some form of a Latin American discount. I guess if I had Chinese companies, they would look slightly cheaper. Like if you have a Pinduoduo, for example, it would look cheaper than a MercadoLibre. But nonetheless, I mean, to me, this company still has a very, very strong runway ahead of it. I mean, look at Amazon. Amazon is a $2.2 trillion company. Of course, Amazon is a major cloud business, which MELI doesn't have. But nonetheless, MELI could get much bigger than this from here. They are the leader in e-commerce in Latin America. Other companies are having trouble in Latin America. They're not doing as well. So I find it dirt cheap, and I'm very much liking this stock, although I don't cover it much on the channel, because I guess there's very, very little retailer ownership of this stock. That's kind of the reason. Moving on to Dutch Brothers, and so for Dutch Brothers, let me ask: should I trust my local Texas freeway being backed up because of a Dutch Brothers near me? Is that an indicator? I can't think of a Starbucks backing up the freeway back in the day when Starbucks was popular. Dutch Brothers is extremely popular among young people. Their drinks resonate with young people. They're very high in sugar. They have a lot of colors. They look like an Instagram account or a TikTok account. And this is exactly the same thing as, say, a Celsius drink. A Celsius drink, it's colorful. It's borrowing all of the marketing of the youth. But at the end of the day, Dutch Brother sells a sugary drink. And I have a very hard time understanding why the stock is up 35% right now. Based on what I see, there was a lot of shorts. And so that could be a little bit of a short squeeze as to why the stock is up so much right now. The numbers are excellent. The market seems to be excited about the fact that they may add food to their stores, and they may be starting selling things like breakfast and like snacks and all of that sort of stuff. And their pilot program that they did in 6 stores, that seems to have been doing well. So they may be launching some bakery items. Again, some form of a competitor to a Dunkin' Donut or a Starbucks, but really doubling down on the new form of what coffee is, which is more something like an ice cream or a milkshake. Really feels more like it. Maybe I'm being a snob here because I mostly drink espresso. Maybe I'm being unfair. No, but that's one aspect. But I know another aspect, of course, is the energy drink. Dutch Brother sells energy drinks. They call them coolers. Starbucks, Dunkin' Donut, they tried to copy them, but they're also very popular with their energy drinks. They look green. The Dutch Brother energy drink is drink, and they use the modern marketing. It's a hip stock. It's a hip company. It is a company that has figured out the Gen Z DNA, just like, say, another company, Cava, for example. They've done that. They figured out the DNA. And a company that I own, Celsius, I would argue Celsius has figured out the Gen Z DNA. Nonetheless, sorry, Dutch Brothers, I find you expensive. At a 0.76, how much am I paying for that growth? I'm paying a 0.76. I find that expensive when I can find a sugary-free operations light business with a higher margin trading as a 0.25. and also a business that has a rule of 59. Okay, rule of 48, that's really good for Dutch brothers. Kudos to you on that. But, I'm sorry, I still think when I look at Celsius, I find Celsius on a growth-adjusted basis, I find it about 3 times cheaper for, frankly, a similar phenomenon. I mean, Dutch brothers is a phenomenon in the United States. There's no denying that. So is Cava, but Cava's valuation is nosebleed. But so is Celsius. Celsius is an equivalent phenomenon, and it is 3 times cheaper than Dutch brother, and it is what, six times cheaper? Seven times. It is 7 times cheaper than a Cava. I would not touch Cava, and I would not touch Dutch brothers based on these valuation metrics. That could be a mistake. That could be a mistake. But there's only a handful someone can have in terms of overvalued businesses. There's like only a handful of stocks on which I'm willing to overlook valuation. These stocks would be Tesla. These stocks would be to a much lesser extent Palantir, right? Palantir, it makes no sense. If I were to look at the valuation, I would want to sell it right away, right? Even more than a Tesla, right? But there's only a handful of stocks where I overlook the valuation because my analysis tells me, or my understanding of a market tells me that they're going to be an absolute leader, right? Dutch brothers, I have a hard time thinking. They could be, but you also have Starbucks' entire willpower, who's going after Dutch brothers. Also, the narrative about GLP-1s, like a lot of people are saying, Starbucks is losing a lot of sales because of GLP-1. In my view, Dutch brothers should also be impacted by GLP-1s. Maybe the only reason why Dutch brothers is not impacted by GLP-1s is because a lot of customers of Dutch brother are young people, and so they don't necessarily are overweight. And maybe the Starbucks consumer maybe got older and got a little overweight and started getting on GLP-1s. So these are all of these interactions. You can see how there's so many moving parts to this thesis. That's why the Tesla thesis or the MicroStrategy thesis is much more straightforward to me. Future of banking, future of transportation. Very straightforward. There's a lot of moving parts, and in my view, there's a lot of uncertainty. I wish I had gotten to Dutch brothers when it was cheaper, but I didn't really understand the value prop, and I have a problem understanding value prop right now, especially when in the same sector, Celsius is so cheap. Oh, of course, if you were to compare brothers to Starbucks, brothers all the way, right? Dutch compared to Starbucks, like if I had to pick one between Starbucks and Dutch brothers as a stock, I would go Dutch brothers all the way. That is obvious, right? One of them is a very bloated company, and another one is a tiny, agile business with small store, small footprint, and that resonate with the next generation of consumers. So that would be obvious. But then again, I don't have to be in the coffee business. If I choose to be in the energy drink / coffee business, I choose Celsius because I think it's an equally compelling play. No financial advice. And the last one, I'll go back to what I was saying about MercadoLibre. Market only cares about short term. Short term bad. There's some margin pressure in the short term because they're building out their logistics. Short term bad, market sells of the stock. Now, explain to me how this makes sense. The CEO of ELF is clearly talking about how they will be impacted by tariffs, but that would be more of an end of next year type of thing. It's an end of next year type of thing. Stock is up 18%. Stock is up 18% because, the tariff, that may be an end of 2025 type of thing. When I see this as a long-term investor, I get worried because I want to own the stocks for a very long run. I don't want to sell the stock on inauguration day. I don't want to sell it on January 20th. I don't want to sell it on the first speech about tariff. Like, what does the market not understand? But 80% of ELF's products are still made in China. And if you look at the narrative, it's 60% tariff. I would argue that's going to hurt ELF when we come to that stage. But of course, that's 2 or 3 quarters from now. And so the market is ignoring that. But me as a long-term investor, I look at Oddity. And when I look at Oddity, what do I see? I see a stock whose 99% of the products at Oddity are made in Europe. 99% made in Europe. So when I look at that, I'm like, okay, 2 resonating makeup brand. Granted, ELF is much bigger. ELF is in the indices. ELF is more stable. Okay to all of that. But both of them are major sellers of makeup in the United States. One of them is going to be 80% made in China and may have 60% tariff, another one of them may have the same tariff as everybody else, which seems like it's going to be 10% if that becomes to pass. So again, 10% tariff, any business can navigate that. That's no big deal. 60% tariff, that would be a really big deal. And they say they're hurrying up. They need to hurry up to get that supply chain outside of China. So I've shifted back my buys towards Oddity, and I did buy Oddity today. And so turns out Oddity was my first love in that sector anyways. So ELF, I guess, will always be a tracker size position for me because I'm going to stop adding to ELF at these levels. And I think Oddity is more compelling on most of the metrics I look at, but even look at more traditional metrics like enterprise value over forward revenue. It's a 2.6 versus a 4, right? How much am I paying for that growth? It's a 0.15. So sure, ELF is doing well. ELF is winning. But ELF is also only 21% sales outside of the USA. The USA is still an overwhelming part of ELF. And, 80% of our products are still made in China. So that could be a overhang over the immediate term. The market only cares about the short term. So I'll be looking back into buying ELF if the market gets scared when in March or in April there's a few China speeches or there's new tariff rhetoric and then the market crashes because of ELF, Remember that the tariff question on ELF's conference call, that was the very first question on the top of analyst's mind. And that question was quote unquote dismissed by saying this will really be an end of 25 type of thing. And so the market, all right, end of 2025, that's not in the model. We're good. We're good to go. Come on. Like I'm a long-term investor. I'm a little concerned about the tariff thing. Oddity, good for you, manufacturers in Europe, my former homeland, I guess, or where I have ELF from. Anyways, American in 6 months. So, anyways, thank you so much for watching. This was not financial advice, not investment advice, just entertainment. Please like, please subscribe. Thank you for watching, and have a wonderful day.